Have you ever wondered how crypto assets are regulated? It's a fascinating topic, especially in a time when digital currencies are rapidly gaining traction and transforming the financial landscape. One key player in setting the standards for this brave new world is the Bank for International Settlements, or the BIS. This international financial institution, often touted as the Bank for Central Banks, is dedicated to fostering global monetary and financial stability. Recently, they've turned their attention to the burgeoning field of crypto assets, publishing a document that outlines the prudential treatment of such exposures. This document is an invaluable resource, providing guidelines for banks on how to navigate the complex and often murky waters of crypto asset regulation. It's designed to ensure financial stability and integrity in the face of this disruptive innovation, and that's what we're about to explore. To understand the need for this publication, we must first acknowledge the growing significance of crypto assets. These digital resources, built on blockchain technology, have rapidly evolved from a niche interest to a mainstream financial instrument. They've become an integral part of the global economy, with their market value skyrocketing into the trillions of dollars. The rise of crypto assets has been fueled by various factors. The promise of decentralization and transparency, coupled with the potential for high returns, has attracted a diverse spectrum of investors. From individuals to multinational corporations, from venture capitalists to central banks, many are now active in the crypto asset space. But along with this explosive growth, crypto assets have introduced new complexities into the financial sector. They've blurred the lines between traditional financial systems and the digital world, creating a new landscape that's as exciting as it is perplexing. This brings us to the second part of our background discussion: the regulatory concerns associated with crypto assets. The unique characteristics of these digital assets pose significant challenges for regulators. Crypto assets are decentralized and operate on a global scale, making them difficult to regulate using traditional methods. Moreover, they're prone to extreme price volatility, which can lead to substantial losses for investors. They're also susceptible to fraud and cybercrime, raising concerns about consumer protection. And let's not forget their potential use for illicit activities, such as money laundering and financing terrorism. These risks, along with others, have raised red flags for central banks and financial regulators worldwide. There's a growing recognition that without appropriate regulation, these risks could undermine financial stability. And this is where the Bank for International Settlements steps in. The BIS, as a bank for central banks, is at the forefront of efforts to develop a robust regulatory framework for crypto assets. Their publication on the prudential treatment of crypto asset exposures is a significant step in this direction. With the rise of crypto assets, there is an undeniable need for regulation to ensure financial stability. This publication serves as a guiding light, illuminating the path towards a more secure and stable crypto asset landscape. Let's delve deeper into the key points of this publication. The BIS document primarily focuses on two vital areas: identifying the risks associated with crypto assets and providing regulatory recommendations for banks. Firstly, it discusses the rising prominence of crypto assets in the financial sector. With their increasing popularity, these digital assets have begun to pique the interest of investors, financial institutions, and regulators alike. The document examines the diverse risk factors that come into play in the world of crypto assets. These include market volatility, operational risks, and risks associated with money laundering and terrorist financing. Moving on, the document provides a set of regulatory recommendations. These are designed to ensure that banks have sufficient capital to cover losses from crypto asset exposures and to promote sound risk management practices. This includes the application of a conservative prudential treatment to crypto assets, reflecting their high-risk nature. The guidelines also stress the importance of a robust compliance framework. Banks are encouraged to develop systems and processes that are resilient to cyber attacks and other operational risks. They are also urged to comply with relevant laws and regulations, including those related to anti-money laundering and combating the financing of terrorism. Furthermore, the document discusses the need for international cooperation in regulating crypto assets. Given the global nature of the crypto market, the BIS believes that a coordinated international approach is crucial to ensure the effective regulation of crypto asset exposures. Finally, the document outlines the implications of these guidelines for banks and regulators. For banks, the guidelines serve as a blueprint for managing risks associated with crypto assets. For regulators, the document offers insights into how they can shape policy to ensure financial stability in the face of the growing prominence of crypto assets. As we can see, the document provides a comprehensive guideline for banks and regulators dealing with crypto assets. It's a significant step towards understanding and managing the risks and opportunities presented by this emerging asset class, ensuring that the world of finance is ready for whatever the future of digital currency might bring. Now that we have an overview, let's dive deeper into the content. The Bank for International Settlements publication lays significant emphasis on risk identification and management when it comes to crypto assets. It's no secret that the world of cryptocurrencies is riddled with uncertainties. The document highlights how banks should identify, monitor, and manage the risks associated with crypto asset exposures. It stresses the importance of robust risk management processes that are capable of keeping up with the fast-paced and ever-evolving crypto landscape. The guidelines recommend that banks should not only focus on credit risk, but also consider liquidity risk, operational risk, money laundering and terrorist financing risk, and legal and reputation risks. Moving forward, the document sheds light on the capital requirements for banks dealing with crypto assets. The capital adequacy framework outlined by the BIS aims to ensure that banks maintain sufficient capital to withstand losses that can arise from crypto asset exposures. This framework is based on the premise that crypto assets pose a higher level of risk compared to traditional financial assets. As such, the guidelines recommend that banks should hold a sufficient amount of capital to cover the full value of their direct and indirect crypto asset exposures. This is a significant move to protect the financial stability of banks and, by extension, the global economy. Next, the publication delves into operational resilience and compliance. In the volatile world of digital assets, banks need to ensure their operations can withstand shocks and continue to function effectively. The document stresses the importance of operational resilience, especially in terms of technology and cybersecurity. It also emphasizes the need for banks to comply with relevant regulatory requirements, including those related to anti-money laundering and counter-terrorist financing. It's critical for banks to have robust systems and controls in place to ensure compliance and to manage the risks associated with crypto assets effectively. Lastly, the BIS document underscores the importance of international cooperation. The global nature of crypto assets means that their regulation cannot be confined within national borders. The guidelines urge regulators to collaborate and share information with each other to create a unified regulatory approach. This cooperation is essential to preventing regulatory arbitrage, where entities exploit differences in regulatory regimes to evade rules. It's clear that international cooperation is key to ensuring the safe and sound operation of banks in the crypto asset market. The document clearly underlines the need for a comprehensive approach to effectively regulate crypto asset exposures. Understanding these guidelines is one thing, implementing them is another. The Bank for International Settlements publication on the prudential treatment of crypto asset exposures presents far-reaching implications for the banking sector as it navigates the uncharted waters of digital currencies. The first ripple effect is the anticipated shift in risk management strategies. Banks, globally, will need to reevaluate their risk assessment models to accommodate the unique and often volatile nature of crypto assets. More than just a simple addition to the balance sheet, crypto assets introduce an entirely new set of risks, such as technological and operational risks, market volatility, and regulatory uncertainty. As such, banks will need to beef up their risk management infrastructure, not only to meet regulatory requirements, but also to safeguard their operations from potential disruptions. The second major implication pertains to capital requirements. The guidance suggests a conservative approach with higher capital requirements for crypto asset exposures. This could impact the profitability of banks venturing into crypto assets, and may even deter some from fully embracing this new asset class. But let's flip the coin. Implementing these guidelines won't be a walk in the park. The challenges are as multifaceted as the implications. From a technical perspective, implementing robust risk management systems for crypto assets requires significant investment in technology and human resources. Given the rapid evolution of crypto assets and their underlying technologies, banks will need to stay ahead of the curve, a feat easier said than done. From a regulatory viewpoint, the global and decentralized nature of crypto assets presents a unique challenge. Regulatory bodies will need to work together across borders to ensure a consistent and effective approach. This calls for unprecedented levels of international cooperation and harmonization of regulations. In conclusion, while these guidelines provide a roadmap, the journey towards effective regulation of crypto assets is fraught with challenges. The road may be rocky, but it's a necessary path to tread for the stability and integrity of the global financial system. Let's quickly recap what we've learned today. We delved into the Bank for International Settlements publication on the prudential treatment of crypto asset exposures. This insightful document, aiming to guide regulatory treatment of crypto asset exposures by banks, serves as a crucial point of reference in the rapidly evolving world of digital assets. We explored the growing significance of crypto assets in the financial sector and the importance of regulation for financial stability. The document's key points, including risk identification and management, capital requirements for crypto exposures, operational resilience, and the need for international cooperation, were discussed. We also considered the global implications for the banking sector and potential challenges in implementing these guidelines. As the world of crypto assets continues to evolve, staying informed is our best defense. If you enjoyed this video and want to learn more about financial regulations and crypto assets, don't forget to like, comment, and subscribe.